Welcome back to internal auditing. We are going to look at, oops, the opposite. We're going to look at chapter 11 today, which is audit sampling. Now, audit sampling by definition is the application of an audit procedure to less than 100% of the items in a population of audit interest for the purpose of drawing an inference about the entire population. So obviously, if you got 2,500 purchase orders, how many of those are you going to select to determine the proper authorization, proper supporting documentation like requisitions has been implemented for these purchase orders? But you can't look at all 2,500 or 25,000 or however many you have. And so that's what this chapter is about, some basic information about sample sizes and risk and such. There's really two general approaches to audit sampling, and that's statistical and non-statistical. This makes sense. We'll look at non-statistical on the last couple of pages. Page 11-2, we have what's called sampling risk. Well, sampling risk, the risk that's associated with the auditor drawing a conclusion based on a sample testing that may be different than if the audit procedure was applied to all items in the population, right? And they go into the two types of risk. The risk of assessing control risk is too low. They call it a type 2 risk or beta risk. And to be blunt, it's the risk that the internal auditor will overstate the reliance that management can place on the control to reduce residual risk to an acceptably low level. So really, it's a specified control is more effective than it really is. That's the risk associated with beta risk. That you've got a sample, things appear like they're okay, but in reality, they're not. The opposite of that is the type 1 risk or alpha risk, which is on page 11-3, which is the risk of assessing control risk is too high. Again, the internal auditor will incorrectly conclude that a specified control is less effective than it really is, that you think you really have an issue and in fact you don't. So this control risk, this controllable risk here is the portion of the inherent risk that management can reduce through day-to-day operations. How do they do that? By reducing it to management's level of risk tolerance. And there the residual risk is a risk remaining after controls have been implemented. But there's always risk. You're just trying to mitigate what occurs there as internal auditors or external auditors. And then there's non-sampling risk there at the bottom, page 11-3, which occurs when an internal auditor fails to perform his or her work correctly. That has nothing to do with sampling. That's just people don't do their job, right? And sometimes that can be intentional, or that can be unintentional. Now you're in a hurry and you don't really pay attention or follow the procedures that you have in your audit plan, and which is really an ethical issue, right? Or you can have issues where it's just an error in non-sampling risk. Page 11-4, 11-5, designing an attribute sampling plan, executing the plan, evaluating the sample results. So here we go into some specifics here in step 1 on page 11-5. And management wants to be, in this example, which I like, they use purchase orders, which is so important. I talk so much about that in intermediate accounting and controllership, very procedural, transaction oriented, the 3-way match, right? An approved purchase order, which comes from an approved requisition, the receiving of the goods or service and the documentation of that, and then the invoicing side of that. And all three have to be matched together. In the old days, those three would be stapled together, and then a voucher would be entered into accounts payable to pay for that. But nowadays, it's all electronic, including the invoicing. So that presents problems or issues, but as well, there's some advantages to that as well. You know, they talk about pre-numbered purchase orders in here. Well, purchase orders may be numbered or assigned chronologically, but it's not, or sequentially, but they're not, you don't have missing numbers unless somebody voids it or does something to it. And then there's an audit trail of what's taking place, which is sort of beyond what the book talks about here. But again, here, Management wants to be confident that all purchases are valid. No unauthorized purchases have been made, and all purchases are appropriately authorized. That's the goal. That's the objective in the audit and the sampling of this. So step 2, there on page 11.5, in this example of purchase orders, right? They want to make sure this prescribed control would include any of the following: a missing purchase requisition, right? No evidence of a purchase requisition approval, like at the department level, before it gets to the procurement department. Maybe approval by an unauthorized person. If it's on a document, of course, now these things are done online, requisition is done online. That really doesn't happen if someone is set up to approve that. You're not going to have something unauthorized. Or if there's a difference between the item purchased on the order versus what's actually been received, which is harder to do as well unless there's some type of a manual override in your software system. But if it's a paper system, overrides can occur. And you got issues not just in quantity or the item, or not just in the item, but you got issues with the quantity. Maybe you received more than you actually ordered for some reason. Maybe the price is different. Most systems have price tolerance levels in, maybe a 0.5% or even 1% difference in the price on the PO versus what's billed. Is that tolerable, right? Of course, it's all a question of materiality. And then the third step there on 11-6, define the population and sampling unit. Here they refer to a term that we looked at back in chapter 10. If you remember exhibit 10-3, the manual audit procedures, here at the top of page 11-6, vouching was one of those manual procedures. Vouching tests the validity of recorded information. It is applied by testing backward, right? Backward to determine whether information in a document is supported by information previously prepared documents. They use the example here of pre-numbered purchase orders. Again, those things are system generated now, unless you truly do have a sort of an antiquated manual system. But it is all theoretical here, what we're looking at. And in step 4, determine the appropriate values of the parameters affecting sample size. What's the tolerable deviation rate, which they go into quite a bit of detail here. What's the acceptable risk of assessing control risk too low, and the danger of it being too high. And what's the tolerable deviation rate? And they make a good point here on 11-7, which is probably common sense. The tolerable deviation rate is inversely related to sample size, right? The larger your sample size, which you're getting closer to your full population, right? The tolerable deviation rate is probably going to be less. All right, then step 5, determine the appropriate sample size. Well, how do you do that? Well, they give a good example here in exhibit 11-1. If you look at 11-1 there on page 11-8, the example that the book gives here, if they've set the control risk too low at 10%, the tolerable deviation rate at 5%, the estimated population deviation rate at 1%, exhibit 11-1 says the appropriate sample size is 77. So if you look at there at the bottom of this page, all right, there goes my camera again. I think slamming my table probably does that, or desk. If you look there at 5% under the 10% risk of assessing control risk too low, if you look under 5%, right, that's the tolerable deviation rate. It comes straight down to expected population deviation rate of 1%. Then we find that the sample size should be what? 77. All right, 77. And then they're going to tell you here later that you ought to just bump that up to 80 from a conservatism standpoint. See, all these accounting principles come into play: materiality, conservatism. Bump it up to 80 as far as your sample size. Don't just leave it at 77 and go from there. Of course, if you were going to do 5% risk of assessing control risk too low, go up there to the top for 1, then that says your sample size should be what? 93. as opposed to 77. More, a larger sample size. If you want 5% risk instead of 10%. All right. And so you see there at the bottom of page 11A, the step 6, randomly selecting the sample. I mean, simple random sampling. Like a random number generator or something that will choose whichever purchase order that has nothing to do with monetary value. That's a different story we'll look at here at the end. But this is simply stating randomly select, if you got 2,500 purchase orders, randomly select those 2,500 somehow. They also have what they call on 11.9 systematic sampling. Involves the internal auditor random selecting a starting point and then selecting every nth item. I don't know if you're trying to do 80 of these out of 2,500. What is that? I shouldn't do that. What, 30 some? So maybe every 30th purchase order, select that one out as being your random sample. But that's systematic sampling. Then step 7 here, audit the sample items selected and count the number of deviations from the prescribed control. So again here, exhibit 11.2, which is on page 11-11. As the book states here, if you increase your sample size from 77 to 80, if we find that on this chart for 10% and the sample size, all right, go down the page there. You see what I'm showing? 80 come out to 1 is 4.8 number of deviations found, and that's up to what? From 1 to 2, there'll be 6.6 for that sample size of 80. All right, so what does that tell us? We go back here. We evaluate these simple results, right? And when we look at top of page 11.10, if you take this, if you have 1 sample deviation, 1 divided by 80, if you have 1 out of the 80, that's what, 1.25%. If you had 2, that's obviously 2.5%. 3 would be 3.75. And so from this hypothetical outcome number, right, the internal auditor can express the statistical conclusion: I am 90% confident that the true but unknown population deviation rate is less than or equal to 4.8%, right? Or it says I'm 90% confident that the true but unknown population deviation rate is less than or equal to 6.6%. All right, so that's a good example. Sort of puts some rubber to the road that shows the sampling process and how to read these charts that are there as an internal auditor or probably external auditor as well. There's always issues. If you look at the bottom of page 11-12, what about these cases of missing or voided documents, right? I mean, look at case 1, bottom page 11-12. Is in the illustrative example above, the internal auditor vouches a sample of purchase orders to corresponding purchase recs, and the 2 purchase recs cannot be found. The 2 missing recs are clearly controlled deviations. There's no documentary evidence of authorization, right? That's important, to prepare the 2 purchase orders. Online stuff now, that's not as big an issue, but here they're talking about kind of the old days when you've got paper documents that this written requisition that's got someone's signature on it can't be found to support what purchasing put into place. Normally, you're going to have copies of all this stuff. Whether the accounting department keeps copies, they'll keep copies of the requisitions, along with the purchase order that comes back from purchasing. They're going to keep there. And then you got purchasing keeping up with that stuff as well. And probably the department that generated the requisition, they're going to have that as well. So, but these things do happen. The second case there as well says the internal auditor has randomly selected purchase orders by number to be tested and finds that one of the purchase orders selected was voided. All right. It is determined after follow-up the voided purchase order is done, that nothing is amiss. I like voiding checks, right? Void across it, keep the checks. If you mess it up or something happens, never throw stuff away and then nobody knows what happened to it. It's a bad thing, especially with checks. You're using check stock. Of course, a lot of that doesn't happen anymore either unless you're a small company. A lot of small companies out there. But the internal auditor, case 3, this is a little bit longer. The internal auditor has randomly selected purchase orders by number to be tested and finds that one of the purchase orders is missing. Internal auditor follows up on the missing order and is unable to obtain a reasonable explanation for what is missing. So the question is, they can apply audit procedures to a selected item that cannot be found. Should this be considered a deviation from the prescribed control? Well, you can read that for yourself because it's about 10 or 12 lines there on 11-13. But what is stated there, some disagree, as you can imagine, because these are gray areas. And then finally here on 11-14, we're looking at non-statistical sampling approaches. Non-statistical sampling approaches. And this one really strikes a chord with me because I know one of the companies I did some work for right before I started at ETSU 7 years ago is bank reconciliations. This company was really small. They had about $7 million a year in revenue, about 50 employees. We had I think we had 12 bank accounts. And some of that was because we did loans, small business loans, but we also had a payroll account, accounts payable account, had the normal account that would draw out of to fill those accounts up when it came time to pay people and pay suppliers. Investment account. We had a lot of bank accounts, and I was the one that did the bank reconciliation every month. As the director of finance and HR, I did those every month because I was sort of independent, looking at checks that had cashed and seeing who had signed them and so forth. And I wasn't really doing anything else other than I did review all the checks before they were signed by 2 board members. But I was sort of independent from that, but I did the bank recon at the end of the month. Well, this is an example of non-statistical sampling that we weren't big enough to have internal audit. We kind of had to do internal audit ourselves, but the external auditors would always want to look at your bank reconciliation. Now, I don't know how many they looked at and verified, 12 months in a year, because these reconciliations bank recons were once a month. So 12 times 12, that's 144 reconciliations a year. How many of those they looked at, I don't know. If you read this example here, it tends to point that on this chart on the top of page 11-15, to control a frequency of control application, if you're doing this monthly, which is what this example is on bank recons, says the appropriate sample size is 2 to 5 for each account. So if you got 12, you're going to do what? Audit a minimum of 24 and probably from 24 up to 60, 5 times 12, 60. So 24 to 60 of those would be looked at. Probably not 60, probably not 24. But I don't know what the external auditors did. I did the bank recon, and then the executive director would look at it as well in the initial, what I had done, because they could see the bank statement, right, from the bank, and they also could see the actual general ledger that I printed out. The trial balance shows the balance of both, but to general ledger to bank reconciliation, if there were deposits in transit, outstanding checks. There's always outstanding checks, especially in AP. All those things had to be reconciled, and the executive director could look at that, and then she would initial that. And I'm sure the auditors paid attention to that as well, because that's authorization, right? Authorization that I did the bank recon. But that's a good example of statistical or non-statistical sampling. And again, much like what we learned about before at the bottom of page 11-15, the risk of incorrect acceptance, type 2 risk, beta risk, right? Conclusion that a recorded value is not materially misstated when it is, right? Like, what if they did 60 of those, and outside of that 60, one of those was wrong, and it was a material misstatement, although bank recons tend to, if you're doing those every month, if you made an error, you're going to catch it the next month. But that is an example of type 2 or beta risk. Or type 1 risk or alpha risk is conclusion that a recorded amount is materially misstated when it's not. All right, so that's a follow-up to what we did or looked at earlier in this chapter. The last bit of this as well is this probability proportional to size sampling. And this is regarding the monetary amounts. Up till now, we're just talking about sampling purchase orders. It doesn't matter if the purchase order is $10 or 10,000, that it's random. Here we're talking about monetary values, which is really pretty common because if you're going to do testing, do those on significant amount. You know, last chapter I talked about internal and external auditor during a physical inventory selecting 45 inventory tickets or locator sheets and going out on the production floor and warehouse and finding those 45 to visually see that they're there. And they would also find 45 tags out there on the product, because there's both two parts to the tag that's on the product and then the tag that's brought in to key in. They would find 45 of those and then come in and want to see that it has been keyed into the physical inventory and is updated to the ledger. Now they didn't really tell you a whole lot about what they were doing, obviously, but kind of hindsight, I do know what they were doing, and they would select the high dollar amounts. And they had a cost of stock status report, which showed them that the part number, the inventory type, because all of our inventory, $24 million might be among 24 inventory types. And under those types, you would have all your part numbers. They would look at the high dollar inventory types like lead or batteries, stuff like stickers, labels, nuts, bolts, things that were low dollar value. They didn't go out there and check stuff like that. It's just they're using this probability proportional to size sampling of going out and looking at verifying the big dollar items. And they try to do it across a lot of different inventory types, but that's where they would select their 45. And this was 45 in the manufacturing side, and then they would do 45 in the distribution side. Probably half of our inventory value, more than half of our inventory value, was in finished goods. The other half was a lot of work in process and raw material. Both sides are important, but so see, they were doing 45 going out there on both sides and then 45 coming back in. So that's really, what is it, 980? And internal audit was doing theirs separately because they didn't really work with each other. They're like two different entities, two different places, doing their separate thing when they would come on site. So selecting sample size based on the dollar value is very important. All right, so that is chapter 11. Again, complete the homework assignments for the deliverables, and we'll look at chapter 12 next time. I hope you have a great day.